Hey everybody, welcome to the channel. Hope you guys are having a chill day. In today's video, I'm going to introduce you guys to a new DeFi protocol. It's relatively new. It launched back in Q4 of 2021. And the best way I can describe it is a combination of Abracadabra, Ramp DeFi, and Platypus. And I think they offer something to investors across the risk spectrum. So if you're more conservative, you can earn yield on your stables. As I'm recording this video, their base rate is 113%, or you can borrow against your LP position. For example, let's say you're yield farming ETH/AVAX on Trader Joe. You can continue to earn yield on your LP position, and you can use that LP position as collateral to mint H2O. H2O is the stablecoin for DeFrost Finance. You can take the stablecoin that you borrow and leverage up, or you could just earn 100% plus APR on it. And in this video, I'll give you guys a brief introduction to the protocol. We'll cover a few strategies and I'll show you guys a tutorial. And towards the end of the video, we'll go over the tokenomics and I'll disclose whether I've got exposure to their governance token, Melt. And for those of you guys who watched the video until the very end, I'll cover a Solana-based NFT project that I recently got exposure to and I think has a lot of potential. And if you want to learn about these yield opportunities or NFT projects that I'm interested in, the best way to get the scoop ahead of me making a video is by subscribing to my newsletter. About 95% of the content is for free. There's a small percentage that's behind a paywall. So if that's something that intrigues you or interests you, make sure you go ahead and click the Substack link in the description below and enter your email address. Now with the intro out of the way, let's go ahead and dive into this video. All right, let's begin with the intro. DeFrost Finance at its core is a decentralized protocol that allows you to leverage your LP tokens or other pool tokens from Avalanche and cross-chain protocols as collateral for generating H2O. At their very core, what they're trying to do is increase capital efficiency. So by that, I mean you have an LP token or LP pair that's generating you yield, but that value is just locked there. It's untapped. By being able to borrow or mint H2O against it, you're able to unlock that value and do creative things from an investment standpoint. If you're more risk adverse, you could take that stable coin and earn a pretty hefty yield on it. Or if you're a complete degen like me, you can borrow against your LP token and leverage up by buying other assets that you're bullish on or buying more of the LP token that you use as collateral. And by the way, folks, when I'm talking about LP token, what I'm referring to is liquidity provided into a certain pool. So if I go to Trader Joe and provide liquidity to this pool here, AVAX/USDT, I'm given a redemption token, which basically says I have a claim on the liquidity that it provided, plus the fees it accrues over time. And that redemption token is often referred to as an LP token. Aside from increasing capital efficiency, another motivation behind the protocol is to increase the options for decentralized alternatives for the existing stablecoins out there like USDT and USDC, because those stablecoins, they can be blacklisted. I'm sure the government's trying to track them. And let's say for any reason, the regulators change their mind and they no longer like stablecoins, it's likely to make them less accessible. And if you take a look at the stablecoin supply, it's grown exponentially since DeFi summer. And let's say anything happens to these stablecoins from a regulatory standpoint or from a trust standpoint, you could see a huge amount of TVL leave DeFi protocols. And so for that reason, I think it's very healthy to have as many decentralized stablecoins the market has to offer. This way, market participants always have a lot of options. And also, let's say if something happens to one of the decentralized stablecoins, at least people have alternatives to shift to. Now that's their vision and that's the core service that they're going to be offering to you guys early on. And as they iterate and assuming they deliver on the promises outlined in the roadmap, we're going to see additional cross-chain assets whitelisted for minting H2O. And by the way, folks, minting and loans might be used interchangeably, but in the context of DeFrost Finance and the services they offer, just be aware that you're technically not taking out loans, you're actually minting against your assets. The reason they use a loan interchangeably is because when you mint against your assets, you're still obligated to return the H2O in order to get your collateral back. And for those of us that are seasoned DeFi farmers, we know that there's a lot of inherent risk when it comes to interacting with these DeFi protocols. And typically in DeFi, the risk that you're taking correlates really well with the yield that you're going to end up getting. And so if you take on the risk of interacting with the young DeFi protocol, you're going to be compensated with a very fat and juicy yield. And over time, as the protocol becomes more battle tested, the community gains more confidence in the team, it'll attract a larger TVL, diluting the yield of depositors. But nonetheless, I still wanted to cover some of the risks that are involved. For example, you have smart contract bugs, there could be a liquidation failure. And typically when it comes to the peg, it relies a lot on market participants coming in and taking advantage of the arbitrage opportunities. And so if they don't do a good job of attracting enough users, we could have a scenario where it takes a long time to restore the peg. And during that time, investors may end up losing confidence in the protocol. And stuff like that typically results in a reflexive death spiral. Also, composability is a risk factor because remember, they're using assets or LP tokens that you're getting from a different protocol, which you're continuing to earn a yield on, and you're using that to borrow against and mint H2O, which means that those funds are technically custodied with that other protocol. And if anything happens to the other protocol, regardless of how secure DeFrost Finance is and how much due diligence they do, if something happens to your collateral in the other protocol, it could cause a ripple effect and hit DeFrost Finance pretty hard. Now that I've given you guys a brief introduction, let me quickly give you guys a tutorial on how to go ahead and borrow or mint against your LP token. The first thing you got to decide to do is pick the pool that you want to provide liquidity to and to use as collateral. And let's say you're uncertain of which way the market's going to move, but you're not a bull or a bear, you're kind of in between. If that describes you, I think one of the better pairs to provide liquidity to is a USD based pair that also is coupled with a token that you're bullish on. And so one example of that would be AVAX/USDT. Currently, you can earn an APR of 32% by farming it on Trader Joe. And so to provide liquidity, you're going to have to come over here to the pools page. Just click here on the pool tab to get directed here. Then go ahead and select the AVAX/USD pair. And you might be wondering why you saw 30% on the previous page and you're seeing about 15% here. And that's because part of this yield is sourced from the yield farming rewards offered by Trader Joe, and the other half is from the pool fees. So as people trade in and out this pool, a portion of that goes to liquidity providers. So go ahead and click on AVAX/USDT. And one way to do this is basically to get an equal dollar value of both tokens. Another way you can do this is by using the zap function. Basically select the asset that you have and it'll equally provide liquidity to your target pool. So in other words, it'll sell that asset for, let's say, half AVAX and half USDT, provide liquidity and return the LP token to your wallet. Next, you want to come back here to DeFrost Finance. Go ahead and click here on Mint H2O. And here you go ahead and deposit your LP token. And one thing I want to highlight was the fact that the minimum amount you can mint is 1,000 H2O. And if my math is right, you need roughly between $2,800 to $2,900 worth of collateral or LP token in order to go ahead and mint $1,000 worth of H2O. Also, the stability fee is 3%. This number is annualized. It's not something you pay up front right away. It'll continuously compound interest. And so our case, if the stability fee is 3%, we won't owe that 3% until 12 months has elapsed. And since the stability fee accrues continuously over time, the user can just pay back whenever they want. Aside from the stability fee, you could potentially pay a 20% liquidation penalty. If you guys wanted some peace of mind, it'd be a lot better to go ahead and use stablecoins as your collateral. Otherwise, you risk losing 20% of your LP token balance in the event that you get liquidated. But the nice thing about using AVAX/USDT is that let's say the market turns south, you'll have more time to go ahead and deleverage before you end up getting liquidated. So let's say you go ahead and mint some H2O, what do you do next? For you guys that are more conservative, I would suggest coming over here to the farming page and clicking here under the H2O curve pool. And when you're directed to this page, go ahead and deposit your H2O as a single asset, but on the back end, they'll go ahead and split that H2O into the other 3 stablecoins. So technically, by depositing your H2O, you'll have exposure to all 4. Now, after you make the deposit, come back here to DeFrost Finance. And just like with the USD/AVAX pair, you're going to be given an LP token for providing liquidity here. You take that LP token, click here on stake, and deposit it. Once it's deposited, you'll be eligible for this APR of 108%. Now, the net result of all of that is, number one, you'll get this APR of 109% paid in MELT token. Now, you're going to get 1/10 immediately. The remaining 9/10 is going to be released linearly every 6 days in 54 days. So basically over 2 months. And I think the key here is getting started as soon as possible, because unlike other farm tokens, I think this token has the potential to appreciate over time. And we'll talk more about that in the tokenomics section of the video. You'll earn up to 35% APY from the Super Vault. As I mentioned earlier, they're basically taking the yield that you're getting from Trader Joe, in this case being 30% APY. They're taking a yield that you're generating from Trader Joe and auto compounding it. And lastly, since you provided liquidity to the curve pool, anybody that trades in and out of the pool has to pay a fee, and that fee goes to the liquidity providers. And you're probably wondering, well, how do I get this 602% bonus? And unlike Curve, where you have to lock up your Curve token, here with MELT, you don't have to lock it up, and you're earning a yield on your MELT token at the same time. So when you deposit MELT into the single coin staking contract and deposit SMELT into the mining pool, it's going to be auto compounding. So in other words, you're going to be earning more and more MELT for free. And while you're doing that, you're also going to be eligible for the yield boost. But as you can see here, if you want to earn something substantial, you're going to have to lock up a significant amount of SMELT tokens. If you're just planning to put 1,000 in, you're just going to get an immediate boost of 3%. So the yield boost is probably not ideal for people that are planning to just hit it and quit it and move on to the next protocol. But for those of you guys that stay committed and believe in the protocol long term, you can compound your MELT. And remember, you're earning this basic APR of 109%, which is paid in MELT token. So you can redeem the MELT token as they become unlocked and keep on staking them into the MELT pool. And if you follow that strategy, you have a chance of accumulating a significant amount of MELT tokens. And I think as the price goes up, there's a potential that they may have a governance vote and reduce the threshold you need for the bonuses. But that's highly speculative, so I wouldn't bet the house on that outcome happening. And on top of the MELT that you're also getting H2O distributions. So 50% of the protocol fees in H2O will be distributed directly to SMELT holders using the Curve H2O boosting contract. This means in the DeFrost H2O Curve boosting pool, users can earn rewards in both MELT and H2O from staking in the boosting contract, while at the same time enjoying boosted MELT mining rewards when providing H2O liquidity. This means by simply depositing SMELT in the boosting contract, you're going to be eligible for the H2O distribution. And this is the current APY distribution from the DeFrost H2O pool. Now, I know that was a lot and it's probably super confusing, but at a basic level, just know that by depositing into this pool here, you'll be eligible for this base rate of 109%, which will fluctuate up and down depending on the price of the MELT token. You'll get 10% of it up front. The remaining 90% you'll get over 2 months. And on top of that, remember the collateral that you used? That's going to be auto compounding, so you're also earning a yield on your collateral. And when it comes to the boosting stuff, just understand that the more MELT that you put into the staking contract, the higher your boosted yield is going to be. So if you're very bullish on the platform and you want to boost your APR, the best strategy would be to buy some MELT, put into the contract, or if you're not willing to buy MELT token, just go ahead and deposit liquidity into one of these pools and deposit the MELT that you're earning and redeeming into the staking contract. Or if you didn't want to mess with the pools on DeFrost Finance and you just wanted to earn yield in a stablecoin pool, what you could do is take your H2O, come here to Curve, trade it for one of the other stables, and deposit here into one of the pools on Trader Joe or another pool that maybe has better yield. And essentially what you've done is borrowed against your LP token and provided liquidity into a stablecoin pool that's earning you double-digit APR. All right, let's go ahead and now begin talking about the tokenomics. I think it's important to highlight the fact that this was a fair launch, so you don't have to worry about VC dumping on you in the future. 85%, which is above average, is going to reward, so the liquidity mining incentives for providing liquidity and interacting with the protocol. 10% is reserved for the stabilizer system, and the remaining 5% is reserved for airdrops and marketing. And they do have plans to compensate advisors and the team, but it all depends on the total value locked. As the protocol gains more in TVL, the rewards going to advisors and the team will increase progressively. The equivalent percentage of the team's allocation will be automatically collected to the contract when the users are triggering claim rewards in the pool. Melt at its core is going to be used as a governance token. This means users will be able to vote on certain parameters like collateral type, stability fees, HTO savings rate, liquidity mining incentives, minimum collateral rate, and other parameters as they iterate and build out the platform. And I think this will become very important as the TVL grows. If they're successful in achieving a massive TVL, and there's a large user base, other project teams and entities will be incentivized to buy the token or keep the tokens that they're earning from yield farming. And for staking Melt token, users are going to be able to earn yields from the protocol's fees generated and mining rewards. 50% of the protocol fees in H2 will be distributed to Melt boosters. Melt tokens will be rewarded to Melt stakers per day on an auto-compounding basis, and the APY could be eligible to adjustment based on the community governance. Melt emission schedule, the Melt emission for mining will be decreased at a 15% rate every 3 months. Now currently there's about 2.2 million Melt on the secondary market. Its price has recently gone up a little bit over 10x after bottoming at 38 cents. It's come down from that high, it's sitting at $2.76. And typically with these early stage DeFi protocols, whether they're successful long-term or not, since the circulating supply in the early days, especially when they do a fair launch, is super low, provided that they're able to return a relatively successful product, do a little bit of marketing, gain some traction in the DeFi community, you'll see a surge of new users and you'll see a significant rise in the price. And these expansion phases are typically followed by contraction phases, because whenever a token goes up by 10-20x, inevitably you're going to have people that are realizing profits, probably significant profits, because there are people who are buying this token at 38 cents, 40 cents, 50 cents, and let's say they put $10,000 in, they 10 to 20x that, they're definitely going to take a little bit off the table. And so what you could see is something like PTP or Platypus Finance, where the price goes parabolic, followed by a big move down. And even with projects like Curve, where you have to lock up the token for a prolonged period of time, you can see that the token price has remained relatively flat. And so I think you're probably going to see the similar outcome with the Melt token. But on the other hand, we have seen tokens like Spell, which you didn't have to lock up, and they definitely didn't have a fair launch. 7% went to the IDO, 30% went to the team, and 63% was used for farming incentives. There was no requirement to lock up Spell tokens to earn a higher yield or get a boosted yield. In fact, it was largely an inflationary token. And despite the poor tokenomics and the inflationary supply, we saw it hit a market cap of 2.5 billion. DeFrost Finance currently sits on a market cap of 5 million. And I think this is a good transition into the next segment of the video where I talk about my exposure to the Melt token. Now, given what we've seen with Spell and the fact that a lot of people have lost trust in that community, I think once this market sideways action or downward action resolves and we start moving back up and people become a little bit more risk on, they'll be more open-minded to trying other alternatives to Abracadabra. And in my opinion, DeFrost Finance is fairly new and it's undiscovered. And as we see some of those people discover DeFrost Finance, I think there's some potential that they may end up at a minimum yield farming. And once they understand the tokenomics, I could see some people even getting exposure to the Melt token. And with the low circulating supply and the fact that it's sitting at a market cap of 5 million, I think the upside is very high. So I did end up getting exposure. My cost average was roughly $1 to $1.50. And so my strategy is to basically stake it, earn this APY of 107%. And if the price goes up too much too fast, I'll probably end up de-risking, at least getting my initial capital back. But unless something breaks or something drastic happens, I'm going to leave a good chunk in the staking pool just to see what happens, because I think they have a strong team. The tokenomics are pretty sound. I don't believe we're going to go into a multi-year bear market. I think we're going to have these mini innovation cycles as Bitcoin generally trends up. So in other words, I'm expecting the market at some point, probably sooner than later, go back to being risk on. And in that setting, I think people will be open to getting exposure to the MELT token. Now, as promised, I'm going to give this bonus segment to the people that are interested in NFTs. I mentioned this in my newsletter a few weeks back. At that time, these were trading roughly at 3 sold. They hit a high of approximately 7 before correcting down here to 5.25. And personally, I have this affinity for NFT projects with utility. And prior to launching their NFT collection, they already had built out structured products that allowed people to earn risk-adjusted yield, and they accumulated or accrued a total value locked of approximately $10 million. And so that demonstrated to me that these guys are serious builders. And basically with this NFT mint, they're trying to raise money to take their project or protocol to the next level. And I think this is part of the larger trend that's happening in Web3. We're seeing increased access to financial products. More and more people are able to have early stage investment opportunities. Because prior to this, many of these projects had to go beg VC for money. Now they can build a minimum viable product, build trust with the community. And with these NFTs, they're essentially issuing a quasi form of equity. I think the most common model that we're going to see adopted is we're going to see these NFTs being used as governance tokens, and the tokens being used as an in-game currency or a platform token used to exchange value. But we're likely to see variations of that because, for example, DeFrost Finance, even though they have this NFT collection, the chess token is going to be the governance token, and if you own the NFT, it's going to multiply your governance power. So for example, if you own 100 tokens and you own an NFT, the 100 tokens now will be weight adjusted to 120 versus the 100 that you had before due to the NFT being in your possession. In addition to getting that 120% voting boost, if you guys buy the NFTs, they're allocating 12% of the chess tokens to people who stake their NFTs. And in the future, you'll be able to evolve your Gen 0 pirates into Gen 1. And that's actually the other bit that attracted me to the project. Basically, the structured product, maybe a DEX or two, are going to lay the foundation for a game. So in other words, much like DeFi kingdoms, they're going to use a core DeFi primitive as their foundation layer, and they're going to build a game on top of it. And now that they've issued their NFTs, next they're going to go ahead and conduct their IDO, and this IDO will be used to provide liquidity to the Treasure Island meta world, seed development efforts, and establish a DeFi C Council. Once the IDO is complete, they're going to go ahead and start working on the game. They're going to release the main Treasure Island map with a functional interface for yield generating chest, NFT marketplace, DEX integration, LP staking, and yield farming. After that's complete, the pirate NFTs will be usable for various in-game functionalities in Quest, including but not limited to earning yield, additional yield, accumulating stats, battle, raids. Moving forward, they'll go ahead and iterate on the game. Users will be able to sail across the treacherous DeFi Sea to look out for rare treasure bearing land, which they can either loot for treasure or settle down and develop as real estate. The real estate agency will also be open for users to buy, sell, and trade islands. After that, we'll see player versus environment, player versus player. So essentially, they're gamifying a DeFi experience, much like DeFi Kingdoms, except in this case, it's going to be on Solana versus Harmony. Now, they also hinted at the fact that rarity is going to play a factor in the game. If you guys wanted more information on the rarity, just head over to moonrank.app. And not to induce a FOMO, but I did see some large accounts of credible people that don't chill openly state that they went ahead and got exposure to DeFi pirates. And for me, I did end up sweeping a bunch, but I think if I had a limited amount of money, I'd probably end up just getting 2. They hinted at subsequent generations, and that implies that we could potentially see some breeding, or they might call it something else like recruiting. And I'm guessing that would probably need 2 or more pirates. And I did want to emphasize before closing this video out that this is considered a very, very early stage investment akin to a VC investment. So by purchasing these NFTs, you're taking on a tremendous amount of risk. However, if they end up delivering, you have a large amount of upside to realize. I mean, if you look at DeFi kingdoms, the Gen 0 heroes are worth 3,000, 4,000 Jewel, which at the current price of Jewel is roughly $20,000 to $30,000. And by lending out your Gen 0s to other people who like to breed heroes, you're able to earn passive income. So assuming that these guys deliver on the game, I'm pretty confident at some point that DeFi pirates could potentially become productive assets, meaning you'll be able to earn yield on them. Now that pretty much wraps up the video. If you guys enjoyed the content, do me a favor, give me a thumbs up. And if you're not subscribed already, make sure you hit subscribe and turn on that notification bell. That being said, this is CryptoOneStop signing out. I'll talk to you folks next time. Bye.